On February 20th of this year, we provided our private members what we do every night, a video view of the markets through the eyes of our algos swing machine, the Nicholas timing model. And on February 20th, the Nicholas timing model fired short. And we told our members the following. Enjoy it. Listen for yourself over the next 35 minutes. This will give you an idea of what we do for our private members on a nightly basis, Sunday through Thursday, for just $99.95. And ask yourself, how much money could you have saved had you heard the following? How much money could you have made? Give it a listen. If you stick around to the end, I'm going to show you our trade manager. It's in the very same trade, and I'm going to show you where it is real time. Here he goes. Okay, everyone, this is Bagger. It is February 20th at almost 10 p.m. I was eager to do tonight's video, and I want to apologize. I got a couple of phone calls from a few people today that my eyes must have been glazed over. I did last night's recap on the market, which we do regardless every night. Sometimes it's a little later than I want, but last night must have been about midnight, and my eyes just glazed over. The VIX daily component had in fact fired long, and it is up from yesterday's call at 5 p.m. to $1,000. Let me explain for the benefit of new people what that means. Last night this fired long. The Nicholas markets were still all long as well. That's a condition that can't last. We know once that happens, one of two things has to happen within about 3 days' time, if not sooner. The VIX needs to go back short, or the markets will roll over and go short. That's the way it's been, and there are reasons for that. The VIX went long, and I really should have pointed that out. It was a harbinger. It was a warning shot, and then sure enough tonight, the Nicholas. Please disregard the TPC for a moment. The Nicholas Dow, NQ, ES, RTY, all fired short tonight, fall through, and at 5 p.m. So Nicholas is now in an official short position. The TPC is a micro. It's not a micro. It is a intraday trending strategy that we've been employing, and that had just a super day today. So in that one trade went off at 11:05, and it's up $2,300 intraday, intra-evening, if one is still holding it. Now, for the benefit of new people, to put a mini contract on each of these markets, all four, including the VIX, calls for a sizable commitment. One must have a trading account if you are going to put this on an overnight basis, in excess of 50,000 at least. When you carry mini contracts overnight, the rule of thumb is to have at least 2 to 3 times the original margin for each contract. So you can do the math from there. So that would be a very sizable trade and commitment, and I don't think anybody should really do that in the beginning. You need to develop your own confidence in the Nicholas and to see what it can and cannot do. It does not get every single trade right, so please know that. It has had some losses. We've had a few losses in the neighborhood of $5,000 to $6,000 in total, and we had one loss close to $10,000 that I recall. We have had run-ups of, both on the short side, high watermarks of 72,000. The average length of the trade over a period of years is about 5 to 6 days. However, sometimes the trade can last weeks. So we don't know. The signal is on. It could lose and reverse tomorrow. It's very sensitive and is meant to pick up these market vibrations. Or we could be looking at this 3, 4, 5 weeks from now, and it could be, up 60, 70,000. So what to do with it? One could use it just as a barometer of the tenor of the market as to where we are and how you might want to position and what you might want to be doing with stocks and with options. One might use just one contract. One might use a micro or two contract. One might use options. Entirely up to you. But like with everything, we can't make recommendations to do anything, and we're not making a recommendation. We're just pointing out what the algo is showing us, and then it's up to each person to incorporate it into their own formulation as to what they may or may not want to do. Okay? So I apologize about missing that last night, but others were watching and said, hey, that's long, and they took corrective steps. We're early. Nobody is looking at what we're looking at. Let's go to the VIX and let's see what we got here. Very, very interesting. Let's slide over here. So look what we have. On a 30-day basis, we have risk-off resumes. 90-day basis, risk-off resumes. In 6 months, risk-on caution. Now, is this going to last 6 months? I don't know. Will be interesting, but right now, today, mark it down. Keep track of these things. February 20th, Nicholas is firing, and he's saying 30 days out, we're going to be in trouble. And he's saying potentially, or the VIX structure is saying 90 days, even 6 months, could be a real problem. Green, moderation, and trending up. A VIX that's trending up out here at these levels is problematic for the market. This is the one that we really, when this goes risk off, we actually blow a siren, literally blow a siren and get that out to our members. So this is very, very important. It hasn't even hinted yet of turning other than over here. It is moderating. Let's slide over and see the rest of the trend information. I'm sorry for that stutter. Okay, so you can see the buying coming in to the spot VIX structure. So somebody got spooked. Don't know what it is, but somebody is spooked. So take heed. At this point, I would be very, very cautious about buying any more calls. We here, very cautious about buying any more stock. We would be looking to exploit to the downside by buying puts and put spreads. If we held any more stock, which we don't, we would be selling some to raise cash. We would be selling covered calls. We would be doing taking defensive steps and steps to exploit what could be a pretty significant pullback. We look at Dow Theory, SPX, and there's nothing wrong with that trend, and that's what's going to have people fooled. The SPX is still showing a very healthy trend. FedEx still very healthy. The yield curve, okay, let's see the problem. So I'm going to open up the microphone. We're making the video for the members tonight, and we are going to actually bring this in so they can see this. This is the problem. The yield curve. See the yield? This is the yield on 90-day paper. It's not 15.38%. It's 1.538. Okay, and it is in an uptrend. It is rising. This is the yield on 5-year treasuries, 1.370. Does it make sense that you give the government your money, a treasury, and get a yield of 1.5 for 90 days when they will only give you 1.37 at 5 years? No. That means it's inverted, and it's been inverted with a 5-year. But remember, we were pointing out last night, we were within 23 basis points last night, 23 basis points of inverting with the 10-year. Look at the 10-year, 1.525. 90-day, 1.538. We just inverted today with the 10-year. That's a problem. Now, other people may say no, but it is. Banks can't make money when the yield is high on the low end of the curve and low in the outer curve. Now, it's not a knee-jerk reaction. It may not, bring out the sellers immediately. People won't even know. But it is also the trend, and the problem is the trend on the 90-day paper is in fact trending up, and the trend on the 10-year is trending down. So it's a problem, and someone's going to have to do something about it if they're going to hold this market together. And the Fed has the firepower to do it. They still have enough firepower. They can cut interest rates on the short end of the curve down here, or they can turn around overnight, 4 o'clock in the morning. The Treasury, I think they subscribe to us, and he says, hey, I just watched the video from Bag of Dawn and I got a problem, and he starts selling 10-year bonds. I'm joking, but who knows? And they push out the rates. And if that happens, this little threat of a market pullback will probably be alleviated. But that is going to be a problem. And so we're seeing it here first. So we're going to bring the screen back for our members. They can get back to watching the market tonight sell down. Now, for the benefit of the members that are watching that, again, it's not a knee-jerk reaction. It doesn't, just because that happened doesn't mean the market's just going to fall apart. But it is problematic in our view. When we look at the skew is off its highs, but still very high. And we've been reporting on this. And what that means is very, very big money is buying puts and selling calls. Very defensive. We're going to now go to the daily action. And we're going to slide this over. And we're going to take a look and see what we see on the daily futures. Okay, so when we look at the daily swing machine, which is the trend, very difficult to turn around. What is it showing? Well, it's very strong still. It's very strong. The YM is just in a dip. That's all it's registered, and the trend is moderating. So we're not making a call that the markets are going to crash. We're not making a call that we're even going to have a correction. Okay, we're only saying at the moment that looks like we're setting up for a little counter trend. And it could be one of those proverbial little butterfly farts. Now, does that butterfly fart in the Sahara Desert grow up to be a big hurricane and come storming across the Atlantic? One never knows, okay, until it actually gets going. So that's all we're seeing. We're just seeing that little butterfly squatting down. It's a little bit of puff. That's all. That's how sensitive and sometimes how early we can be. All right, so we walk you through these signals because when this is sitting on your machine, hopefully for a lifetime, there's no way. You're not going to need anything else. You're not going to need the Wall Street Journal, yesterday's, your newspaper, or last week's magazine to tell you where the markets are going. We're trying to give you the latest tools that we have. There may be more in the future, but the latest tools with sound discipline and relationships so that you can begin to make market calls. We look at currencies and they are what they are. This is problematic for the bulls. It's a very strong dollar. We've mentioned that before. These are not futures. These are the canary in the coal mine. They're still very long, so it's still a little early. Everybody is still very, very complacent market still. But we've been pointing out the Treasury market itself is very long. And this is not confirming the strong position in equities. And The Treasury market is much bigger, much deeper, much smarter, much more stable, and they're just not buying the move. They're saying basically the economy isn't as strong as the equity bulls would have people believe, despite Cramer. Gold is really moving out. 41 days ago, you could have gone long on a daily basis gold at 1510. One contract long gold, okay, you'd be up 11,700. One contract overnight margin in gold, I think, is about $6,000. Almost 100% return on your money. All right. My brother in Orlando is doing, he's polishing his gold. He's a very, very happy boy. Copper short up, and silver moving out. 5 days. 5 days. One silver contract, you'd be up 3,400. Silver is moving out, and the trend is strong. Oil is still short. It's ripping against the short, but it's still short. Heating oil, same. Nat gas, same. And gasoline, notice gasoline rising and along. And then the grains, they are what they are. I'm not going to comment, but we do play grains. And there they are. Now I'm going to pause and slide over. Okay, and these are the support and resistance levels. Very, very important for swing traders. Even important for intraday traders. You'll want to know where we are in these if you're playing any of these markets. And you can see now treasuries are really, they're pushing the high side. But remember, in an uptrend, they will blow out resistance levels, right? Just like Tesla. And in the downtrend, they blow out support levels. So just because something hits resistance doesn't mean that it is in fact coming back. It may not. And you can notice, remember last night we were up in here. We were pushing 3,400 on the ES. Look where we are now. We're pulling back. So we in fact did, in this instance, from where we were last night, pushing into resistance and have come all the way back. At 11, I think it was 11:30 or 12:30 today, somebody dumped 250,000 ES contracts on the market. Very, very sharp correction. Zero Hedge wrote about it and said, and nobody saw it coming. We were in the room. That's where the TPC picked up that trade in advance. Was phenomenal. We all saw it coming. We saw it coming off of the swing machine. It's like watching a wave come in, even where it happened on a 10-minute basis. You see, because the swing machine is 1 minute, 3 minute, 5 minute. I mean, if you're going to have to be able to do that in less than a minute. But they did it in 10. They probably got another leg that they want to do, maybe a few more legs, just a warning shot. And but we were able to pick that up. And I want our nightly members, our monthly members, our swing traders to know that. So don't think that we can't get inside that. We saw it, and our programs picked it up and traded it. We put on for demonstration purposes, we put on a Tesla put contract. We put 10 of them on at that time. It was a $41,000 example. And in less than 10 to 15 minutes, that put went up to $22,000, a 50% return. And we certainly would have had, as you know, we do with everything, right? An outlier profit target. Now Wall Street wants you to give them their money every day of every year, and maybe they return, 6%, 7%, and run the risk of a 50% haircut. That's the nonsense of it all for them, and why we do what we do. Let's let's look at the intraday and let's see what we see intra evening here. And here we are. So this is the daily, this is the 240, and on the ES contract on an hourly basis went short 11 hours ago. The NQ 11 hours ago We're dipping on the Russell, and the VIX went long 11 hours ago, and the YM went short 18 hours ago and is up. So this is where the turn, if there is going to be a turn, this is where it will start. And these trades could be very, very healthy. Entirely possible over the next, well, tomorrow's Friday, but we could be looking when we get to Tuesday or Wednesday. It's possible, I'm not saying it's going to happen, but it's possible that these positions could be up thousands of dollars each. They will ultimately roll these over if it's going to develop into something more, and then ultimately at least put them into dip territory. There you saw it. You just saw it live. You just saw the ES contract on a 240-minute enter into alerting a short entry. It's got these conditions for the ES have got to stay where they are for 4 more hours to turn this into a short signal and light this up with a red letter 2. So it's kind of neat that you saw it just there. That's how that works. Now, everybody might want to play these. You have to understand, with everything, no matter what it is you're trading, futures, stocks, whatever, when you increase on a price chart, when you increase the size of the brick, when you increase the size of the box on a time chart, when you increase the time, when you go from 5 minutes to an hour, from an hour to 4 hours, from 4 hours to a daily, to a weekly, to a monthly, you increase your risk. Yes, you do increase your profits, but you increase your risk. You increase the size of your losses when you do lose, when you get it wrong. You increase the size of your drawdowns. It's a trade-off. We can't take the risk out of this game. So you do need to understand the probabilities and the nature of playing within yourself and playing within your risk capital. The game is the same no matter where you're playing, very intraday basis or playing for a monthly. The probabilities don't change, and therefore the game doesn't change. As a general rule, okay, if you want to be around for the long term, as you increase the size of your bricks, as you increase your time horizons, folks generally reduce their exposure, reduce the size of the wager, right? Reduce it. When we're trading intraday, we're putting on larger positions or using leverage because we're going to be in and out. We're not going to be in very much. We're trading with surgical precision. So I hope that makes sense at some level. Let's go to the daily ETFs. Now the daily ETFs, they don't see a thing. This is beautiful, right? They're all long. And so the sheep, they just think tonight's just another night. They don't know what's coming. They're on A1A, heading out of Miami, going to Key West for the weekend, and we see a hurricane off the shore, or possible one, or some bad weather. They don't see it. They got no GPS. They have no radio. They have no mapping tools. They have nothing. They just got a trunk load of cerveza and ice, and they're going to have a good time. Good for them, okay? I love the Keys, but I just don't want to be down there when there's a storm. So it is what it is. They're not going to see it. They never do. The futures always lead. And we say this all the time. It cannot, what's this FXS? I don't know. That used to be Spain. We're going to find out what that symbol was and try to, why that, let's try and see if we can refresh it. I don't know. I'll tell you what, I'll take it out. I don't think anybody's going to miss. I don't know what that was. We'll save this. Now we're going to save the workspace. Okay, and so you see the currencies for what they are, and I'm going to pause and slide this over. And now up we come. So you get to see support and resistance levels of all the ETFs. Okay. Now we're going to go to the S&P 500 and we're going to see who was leading today in percentage terms. That's interesting. E-Trade must have been on earnings. E-Trade, Albemarle, VTR, Newmont, MPC, Jeweler, Signet Jewelers. That's made a big move. And Harley Davidson. How about Dow? Hormel, Synopsys, HSIC, Cabot, Limited Brands pulling back 4 or 5%. That was one we had mapped out in the low 20s, ran right up in there, and it's now pulling back. That's all it is just a pullback in all likelihood. And it could be forming the handle to a cup. So be sure to look at Limited Brands on a daily chart and see if it looks like it's forming that handle. If it is, you want to let the handle form and then wait, and then it could explode. And that next move would take out that 26, 27 area, as I recall, and probably push the stock up into the 30s. Wouldn't be surprised. Clack, Garmin. Now, what signals in for today? And here we have some short signals and some long signals, and here they are. Be sure to do your due diligence, put them on a chart, look at them through the eyes of Renko with %B that we hopefully have taught everybody. Put them on, larger bricks on Renko's point and figure. You want to get the entry right. This will alert us that it's starting a trend, and you should be able to see the entry. The entry may or may not be there tomorrow in the direction you want to go, and you don't force it, but it might be too. Okay, we just don't have the time, and it's not necessary for us to start pulling up a chart. We show you how to read the charts, and if anyone's got any questions on there still, if we haven't answered those questions for you, we will. I'll show you exactly how to read it, keeping it simple. You don't have to have all this stuff on it. Swing Machine is doing that for us. I mean, it's doing it it's in a much better fashion too. It's giving you really what you need. Let's look at the NASDAQ, and let's see who is up. SBAC, Veritex, O'Reilly, Ulta. Not a whole lot. And then how about down? And then Tesla, Amazon. People have made a small fortune. If you had put on, I think we said it last night, if you had put on $10,000, $15,000 in options back in September for 3 or 4 months, chances are those and they were call options long, would probably be over $1 million. That's how big the run was. Just because 10 options would have been 1,000 shares. Probably would have cost you 15 grand to go out 90 days, and you would have just somewhere between 700,000 and $1 million. There are those opportunities. Let's look at the option page so we can see what's going on with the averages. So see the diamonds starting, the SPY starting to slip, the diamonds, which are the Dow, they're starting to get underneath these averages. This has been solidly green. This is going to grab the attention of the wealth managers and of the sheep. They love to watch these moving averages. They're usually very late. It isn't going to take much. One day we could be all submarining underneath the 50-day. It'll take them weeks to realize what's going on. CNBC will not report on it. They want to wait until the 50 crosses the 200. That could be a month from now. These people will already be down. It'll be the averages lag. So people's stocks and portfolios could be down 20% by the time the 50 crosses the 200. That's why you never get the trade. It's an optical illusion where the averages cross. The prices have moved out either up or down before. It's silly to think that. And we know that the 5200 really doesn't work. In a very bullish sense, it might in a bullish phase on the long side, but as far as the strategy goes, it's not very good at all. It's no strategy. But they'd use it because it sells and it's easy for them to explain. And at a sheep level, it makes sense and they buy it. Let's EFTC, a little rocket ship. XEC, same thing. EQT, moving. Albemarle, little rocket. Newmont, rocket. Hess, rocket. They're just rocketing up over that 5. They're just, bursting off that platform. So this is a great little place in here to get the top 10 or 15 because when they come off of that, they will at least carry for the next few days. They'll keep moving. They just don't usually just explode like that off the platform. So you have this on your desk. You want to look at these if you haven't been. Now let's catch the submariners. This floor has been submarining. Didn't today, but this one here did today. NCLH, Norwegian Cruise Lines. Well, that makes sense. We had Copart. You want to have all the cruise lines, right? Those guys they could be faced with going out of business. HRL, MRL. They probably insured their own stocks at this point. And then here's that Limited Brands. And Limited Brands is just, it's just not torpedoing, but pulling back. It does need to stay above its 50. It could get underneath its 20 or bounce off of it and then come right on back. You'd have to look at a chart on it. And that's really that. Tomorrow is Friday. So Sunday night we'll look at the options for next Friday. Let's look at the Pebble Beach signals, and here they are. And be sure to take a peek at them. Here are some more opportunities, some big ones. Facebook, Pebble Beach sell, CMG up here. CMG, 926. Are you freaking kidding me? My God, look at that. Look at that run. Also getting a Pebble Beach sell signal. Really ripe to come back. It's thinly traded. I don't know if it's one of those hedge fund hotels, so be careful. But see now Avalon Bay has been running because interest rates have been coming in, and it's a knee-jerk reaction when the interest rates come in as people plow into treasuries. The real estate market goes bonkers. And I think treasuries are going to keep going, so unless they get engineered, right? If we come back on Sunday night and the market gaps down in the morning and then the market comes roaring back, and Sunday night we see that the inversion has been twisted out of the way, well, that just didn't happen by accident. That's the Federal Reserve recognizing that, this is what we got to do. So we'll see. Remember, we came within like 2 basis points of that inversion before, and it got taken out. We will give you the out of bounds tonight. These are buy signals. These are stocks that were really oboe south. They were really extended to the downside, and now they're moving out. Those could be worthwhile to look at. And then oboe norths, there's a ton of them, and quite a few. And these are stocks that are really, really extended to the upper side. And then oboe south really extended to the downside. And then all these short signals are stocks that were yesterday in oboe northland and are coming back in. Still very actionable, so feel free to take a peek at those. And then we're going to go to the chart and look what we got. And here's the VIX, right? Moving on up. Remember we said the other day? We said just last night, just the last couple of days, this VIX right here was a false low. This because the percent B is up here and the percent B was down here when price was up here. So we should be buying the VIX. And if we're buying the VIX, we should be selling the market. VIX wants to go for some reason. It's technically very, very ripe, and it just needs a match. Now let's go over, I got to get the S&P, and here we are. Now this is what the S&P did today. This, once again, this is a hanging man candle. It's a hammer when it occurs down here after an extended rundown, or down in here. These are little hammer candles. But when you get what looks to be a hammer after an extended run-up on top of this extended run-up, that's called a hanging man. And it is a sign of a reversal coming down. The low needs to be taken out within the next 3 days, and then we'll be able to say that was the signal. Actually, it was this candle here is the other one, the little inverted hammer. So watch today's low. We want to see today's low get taken out and hopefully close it down. I think it's coming. I really do. It looks ripe. And I tell you what, that's it. We're 35 minutes. I want to get this out to everybody. My apologies for not catching the VIX move yesterday, but that's why we go through what we go through, and you have it on your desk, and you can always, be looking at this and interpreting it for yourself. We're getting a little data interruption on our other screen. So with that, we're going to say good night and good luck, and I will see everybody Sunday night. Okay, everyone, I'm back, and this is Bagger Don at Stock Market Caddy. Today is March 12th. The video you just watched was back on February 20th. Let me show you a couple of positions that we were showing our private members back on the 20th. In that video, you saw the 240-minute ES actually fire live that night. It was 2 a.m. It was 2 a.m. It was February 21st is when it actually confirmed. So it was firing that night, and then took into the next day for that to fire. Had you taken, with Swing Machine's help, had you taken any of those trades, you would be up 35,000 on one contract on the ES, 35,000 one contract the NQ, 23,000 on the RTY, the Russell, 25,000 on the VIX, and 32,000 on the YM. Let me show you the Nicholas. This is the Nicholas. Here's the Dow. Here is the Russell. Here is the NQ. Here is the ES. And here is the VIX. Here is the VIX component. It actually fired on the 19th, but it was very, very close to the date, and it has since actually signaled on the 20th. But one contract in the VIX at that time, you would be up 25,800 real time. But here are the signals that you saw to short the market from Nicholas. 32,785, one contract. 23,760, one contract. 38,185, and 35,862. Now we are off our high water mark, but one futures contract, one mini contract in that market call, and you would be up 156,000. Earlier tonight, it crested over 165,000. Had you done it with a micro, your payout would have been maybe 15,000 with a micro. Had you purchased a put, and we did, and we have folks that did, on the 20th, when the S&P was trading out of the entry price, let's look at the ES. The entry price was at $33.69. We shouldn't have a dollar sign there because it was just the entry price. 3369.25. A put, a 30-day put on February 20th was $4,000. If the market opens roughly where it is now in the morning or lower, that put would be worth approximately $80,000. I know what you want to know. What is the Nicholas timing model? Folks, it's an algo. It's an algo. It runs on 3 or 4 data streams. I cannot discern when it's going to make the call by looking at anything on a chart, because the reality of it is a lot of the stuff that you're looking at, some of it works, most of it doesn't. But relationships matter. And fortunately for me, I married up. My wife, Susan, has an IQ of about 160. And she helped me write an algo that looks at price and the price action in a very, very unique way. This is not the first call of Nicholas. In any case, I want to thank you for your time. My name is Don Marshall. I do not come from Wall Street. I am not a banker. I spent 25 years of my life teaching surgeons how to do surgery, believe it or not. Back some years ago, now 10 to 15 years ago, my wife and I set out to develop tools and instruments, much in the same way a surgeon might, so that we could demystify the markets for ourselves and make decisions to manage our own money. And that's what we did, and that's what we've done. I have no interest in managing anyone's money. It's not worth my time. Our way of paying back is to help other like-minded people who want to take control over this part of their life learn how to trade the markets. Whether you want to trade intraday, swing trade, or even invest. At some point, I think even Warren, Mr. Buffett, wants to realize a profit. It's called selling. Or maybe you want to sell a deep in the money call. The timing matters. The entries matter, and so don't the exits. So if you want to know what Nicholas is doing on a day-to-day basis, go to our website, stockmarketcaddy.com. Be gentle. We built the website ourselves, too. You know, when you do it yourself, you know how to fix things. So we built that website. And for just $99.95 a month, we're going to give you a video Sunday through Thursday. We realize you may not be able to watch it every night, but we don't know what night you will watch it, so we don't shortchange you. And that video could be anywhere from 15 minutes to an hour, no more than an hour. And it has a lot of actionable information that you could use and merge with what you're doing. And maybe use it to discuss things with your financial advisor or brokers or what have you. That is up to you. We do not make specific recommendations to buy or sell anything. Trading in the markets is not easy. We're not saying that you're going to get rich quick. But we are going to give you a view of the markets that you probably have never seen before. I'm going to try to demystify them for you. If you would like to talk with me, I'm a real person, and you're welcome to call at 813-758-8263. Again, my name is Don Marshall. And if you don't call us for that education, that's okay. We have a little jumpstart program that we do for everybody. And by the way, you can lease these tools. We do have a program to lease these tools where they can be on your computer. They are not for sale, though. But we're happy to speak with you. So with that, we wish you the best. And if you don't call us, at least get an education from someone. There's a lot of good information out there. There's a lot of bad, but there's a lot of good too. And trading in the markets may not be surgery, but we approached it as if it is surgery. We trade with surgical precision, day in, day out. Thank you.